Welcome back everyone, I'm Jordan Giesecke, and this is The Limiting Factor. This video is the fifth section of a full 2-hour-long video on the Global Lithium Supply Chain that's currently available for paid supporters on Patreon, YouTube, and X. In the last video, I walked you through my global battery supply forecast for both lithium and sodium-ion batteries. And today, after 2 months and 4 videos, we're finally going to take a look at what all the information we've covered means for Tesla specifically. Before we begin, a raft of credits and thanks are in order. Feel free to skip this part of the video and move to the next timestamp if you watched the previous video. I'm including the thanks and credits on each video in the series for the people who haven't seen the other videos. That's because it's not just a thanks, it lets viewers know the quality of my sources and peer review. First, Vivas Kumar reviewed the draft script. Vivas was directly involved with Tesla's battery supply chain for nearly 3 years, where he negotiated billions of dollars of materials spend and also did strategic analysis and forecasting for battery materials. After that, he worked for Benchmark Mineral Intelligence for nearly 3 years. He's now co-founder and CEO of Mitra Chem. If you'd like to know more about that, check out my interview with Vivas and Chiru. Next, my sources. Rodney and Howard of RK Equity, a lithium analysis and advisory firm, spent several hours and long email threads answering detailed questions about mine development. If you're interested in their work, you can connect with them on Twitter with the details on screen or follow the Rockstock channel on YouTube. Cameron Perks of Benchmark Mineral Intelligence walked me through how lithium supply and demand is evolving over time. I recommend following Benchmark Mineral Intelligence and their CEO Simon Moores on Twitter to keep up to date with the lithium industry. Lars Leesdahl provided key data for this video around lithium refining capacity versus production, and beyond that, I've used a number of graphs from Rystad Energy over the years. You can also follow Lars on Twitter. Austin Devaney helped me put a finer point on a few topics around hard rock lithium mining. Austin was an executive at Albemarle and Rockwood Lithium for nearly 10 years, which is one of Tesla's largest lithium suppliers, and now has been at Piedmont Lithium for the past 3 years, which has an agreement for future supply to Tesla. Bradford Ferguson and Matt Smith of Rebellionaire.com reviewed the final release candidate of the video from an investor lens. Rebellionaire specializes in helping investors manage concentrated positions. They can help with covered calls, risk management, and creating a financial master plan from your first principles. Bear in mind, this video is not investment advice, and always do your own research. Finally, despite all the input I received from some of the leading experts and information sources in the lithium industry, all the opinions in this video are my own. There are differing views and forecasts within the lithium industry that I had to reconcile and combine with my own insights and expectations. With regards to the peer review, it was for factual accuracy and a sanity check rather than for crafting the tone and conclusions of the video. Overall, my goal was to create the most comprehensive resource out there on how global lithium supply and battery supply will evolve this decade and how that relates to Tesla. So if you feel like I've hit the mark and get value from the video or my content in general, toss a coin to your witcher. Making a video like this takes months, and generally, analysis like this would be packaged up by an analyst house and put in a report that costs thousands or even tens of thousands of dollars. Generally, I make about $200 to $600 per video in YouTube ad revenues. That is, it's the direct support that I get from less than 1% of subscribers through Patreon, YouTube, and Twitter that makes the channel possible. The details for support are in the description. Picking up where we left off in the last video, now that we've established a forecast for battery supply for the rest of the decade at a global level, let's specifically look at Tesla. What share of global battery supply can Tesla scoop up? And if they do face a crunch, when could that happen? Bear in mind, the goal here isn't to be highly precise because we're already dealing with so many unknowns, but to get a strategic view of the challenge that Tesla's facing and how they could respond to that challenge. To kick things off, I expect that Tesla will use between 150 to 200 gigawatt hours of battery cells this year from all sources for all products. Tesla stated that, on average, their goal is to grow 50% per year until 2030. If they hit that target, in 2030, they'll be consuming 3 terawatt hours of battery cells per year. 3 terawatt-hours is also the number that Tesla gave at Battery Day. So Tesla set firm expectations for a 3 terawatt-hour consumption rate in 2030. If we take the cell supply data points for each year and divide them by the cell consumption data points for each year from Tesla's expected battery consumption, the result is the graph on screen. What we're seeing is Tesla's battery demand as a share of global battery supply for each year from now until 2030. It grows from 16% this year to 47% in 2030. One big caveat with this graph is that it's backstopped by one overriding assumption, which is that Tesla will continue to have the highest margin of any EV and grid storage company. That, in turn, will allow them to pay the highest price for batteries and battery materials, and gain greater access to battery supply than their competitors. On that note, Tesla's battery supply is often viewed as black and white. That is, there's enough batteries or there isn't. But the reality's a bit more nuanced. Supply is somewhat variable to price. The more Tesla is willing or able to pay for batteries and lithium, the more they'll have access to. I say somewhat variable to price because most battery cell manufacturers prefer to diversify who they do business with, and because it's dependent on how well Tesla's planned out their battery supply for each product, which each have different requirements. To say the quiet part out loud, if Tesla does manage to secure greater cell supply through greater buying power, it necessarily involves putting some competitors out of business that are already struggling to turn a profit. I'm not saying I want that to happen, just that it's the most logical outcome. So if Tesla can afford to pay the most and therefore buy all the batteries and battery materials they need, the sky's the limit until they're consuming all the batteries in the world, right? No. In my view, at some point in the latter half of the decade, Tesla will start bumping up against government pushback and/or the market share displaced by other automakers and energy storage manufacturers that have successfully made the transition to renewable energy. For example, Tesla and BYD are currently the only major auto manufacturers that can turn a profit on EVs, and they're neck and neck in growth and sales volume. If that continued, even if no other companies survived, Tesla would end up with a 50% market share in a best-case scenario. But more than half a dozen auto manufacturers will likely survive. That is, it'll be difficult for Tesla to consume more than a third of global battery supply, which will happen by around 2028 if they hit their growth targets. If you disagree with the 33% estimate and believe Tesla will max out at consuming, for example, 20 or 50% of global battery supply, you can run your finger along the x-axis to get an idea of when Tesla could start facing challenges. As a side note, earlier I said that my battery supply forecast was aggressive and on the bullish side. If we take that into account and assume a less bullish battery supply of 5 terawatt-hours instead of 6.4 terawatt-hours, Tesla would be consuming 33% of global battery supply a year earlier in 2027. Bear in mind that 5 terawatt-hours is still 43% above benchmark's 2030 supply forecast, so it's still bullish against the baseline. After taking all that into account, if Tesla doesn't take a more active role in lithium mining, they'll start facing a lithium crunch as early as 2026 if there's fierce competition, but no later than 2028 if most of the competition goes bankrupt. We'll say 2027 as a base case. After 2027, Tesla might see their rate of battery consumption growth drop from 50% in 2027 to, for example, 42% in 2028, 29% in 2029, and 22% in 2030. Again, that's if they don't take an active role. We'll talk more about what Tesla can do in a moment. On a related note, I've seen people concerned that Tesla is being outcompeted by companies like Ford and GM, which seem to be on a lithium sourcing bonanza. Here's my view on that. Tesla tends to sign with the largest lithium producers in the world, but just doesn't advertise it. Tesla's never shared much about their lithium supply because there was no reason to, and so it's business as usual. That is, the absence of information isn't necessarily a cause for concern. In fact, the argument could be flipped on its head. It could be that GM and Ford investors are concerned about competition from Tesla, and so GM and Ford are making announcements about locking in lithium supply to put investors at ease. I'm not saying that is the case, but rather we don't know the minds of the people involved and their strategy. And because we don't know, it becomes an exercise in imagination. Getting back on track, if Tesla's 50% growth rate is in jeopardy later in the decade and the primary cause is a shortage of mined lithium, what can they do about it? If Tesla took a more active role in the lithium mining industry now, with lead times of 4 to 7 years for a new mining project, there's still an opportunity to make an impact by the end of the decade. I'd be surprised if they could bring enough new mined lithium supply online to fully cover the supply gap, but even an increase of 10% would be enough for another 2 million vehicles per year by 2030. But in my view, even if they weren't successful at increasing the supply of mined lithium, it would still be worth their time to become more active in the industry. Why? First, as I said earlier, Tesla's paying large amounts to both lithium miners and refiners, not 4 years from now, but today. Those margin costs could be running over $1 billion per year. Furthermore, the better the battery industry gets at manufacturing batteries, the greater the proportional cost of the raw materials. That is, the best way to reduce the cost of lithium-ion batteries is now to reduce the materials bill. And the best way to do that is to cut out the third-party margins. The second reason it would be worth Tesla's time to become more active in lithium mining is that the industry doesn't always share Tesla's goals. Tesla wants as much lithium as possible at the lowest cost to accelerate the transition to sustainable energy. Lithium miners are looking to maximize profits and minimize risk because lithium mining is a capital-intensive, risky business. That means what's best for miners is to increase lithium supply, but not so much that it exceeds demand and creates thin or non-existent margins. So overall, if Tesla wants to be the master of their own destiny, rather than be held captive by third parties, in one form or another, they may need to take a more active role in lithium mining. The logic here is the same logic that Tesla used for vertically integrating into battery cell manufacturing, cathode production, and lithium refining. Vertical integration can accelerate the speed that they scale, reduce margins paid to third parties, and de-risk the business. To be clear, I'm not suggesting Tesla necessarily has to vertically integrate into mining, but that they may need to take the supplier relationship one step further to form partnerships. On that note, if Tesla does decide to take a more active role in lithium mining, what are their options? First, they can finance or partner on mining projects that might be struggling for capital or need money to accelerate development or increase production. This is the best option in my view because it allows Tesla to keep some distance from some of the negative sentiment around mining. Second, Tesla could buy one of the major mining companies. Besides hitting the accelerator on the speed of extraction, Tesla could let the lithium contracts of their competitors expire and redirect that lithium supply to themselves. That is, a buyout would be the nuclear option and Tesla might come under fire for being monopolistic. Third, and finally, Tesla could become a miner themselves by buying, exploring for, and/or developing mines. This is the worst option in my view because it carries the most technical and reputational risk without much additional benefit. If there's so many reasons for Tesla to get into lithium mining and so many ways to structure that, the question then becomes, why has Tesla said that they'll only get into lithium mining if they have to? I see 5 reasons, which aren't mutually exclusive. First, because lithium mining creates a lot of social and environmental headaches, and Tesla's trying to avoid associating themselves with those issues. Second, on more than one occasion, Ford CEO Jim Farley has said that they're securing lithium supply 3 years in advance. By this, I'm assuming he means confirming lithium production volumes and costs and signing the contracts. It could be that Tesla's looking 3 years down the road at lithium supply, and it still looks pretty good up until 2026. That is, a shortage of mined lithium hasn't hit their radar yet, and it's still a theoretical risk. Third, it could be that Tesla intends to buy a mining company and they're downplaying mining because they don't want to inflate the price of lithium mining stocks before making a purchase. Fourth, as Elon said, it could be that they're avoiding vertically integrating into mining because vertical integration diverts resources. That is, building or running a lithium mine could slow Tesla down on other projects like building vehicle factories. Fifth, and finally, it could be that Elon is being over-optimistic about lithium mining because it doesn't appear to be a technical challenge. That is, he may be underestimating the array of other, non-technical challenges involved in lithium mining. With all that said, despite all the reasons Tesla may not be considering or may not want to get into lithium mining, I think they eventually will. That's because although Elon tends to be over-optimistic, he's usually good at course-correcting when reality makes itself apparent. If Tesla's locking down lithium supply 3 years into the future like most companies are, and the assumptions in this video are correct, we might expect more aggressive action from Tesla in the next few years. Before I close out the video, it's worth addressing the dozens of other potential battery chemistries beyond lithium and sodium ion. There are a lot of promising technologies out there, such as vanadium flow batteries and liquid metal batteries. However, in my view, they won't scale quickly enough to make a big impact by the end of the decade. Sodium-ion batteries are evidence of that. They're ready for commercialization, comparatively easy to scale, and the materials are abundant. But even with all those things in their favor, they're unlikely to take more than a third of the market by the end of the decade, and likely much less. Beyond that, every battery chemistry has strengths and weaknesses. The implication of that is that each chemistry has specs and economics that lend those chemistries to specific use cases. Those use cases might have no overlap with lithium or sodium-ion batteries, or the use case could be so narrow that the market of the chemistry is 5 to 10% of the total battery market. Now that we've covered the major sections of the Global Lithium Supply Chain video, next month I'll release the full video that contains about 15 minutes of extra content at the beginning and end of the video. The introduction contains a too long didn't watch that provides a quick summary of the video. That's useful if you're looking to share the key themes of the video with someone that may not have time to watch the full video. If that piques their interest, the video is fully timestamped if they want to explore further. The summary reiterates the key points of the video as well as addresses the frequently made but poor comparison between lithium shortages and the peak oil hysteria from 15 years ago. That's all for today. As I said at the beginning of the video, if you can, toss a coin to your witcher. The information I've provided today is, to my knowledge, the most comprehensive video on lithium supply out there. Other reports that are available on the market can cost thousands of dollars, and by comparison, if this video does well, I expect it to make less than $1,000 from YouTube ad revenues. It's the supporters who contribute directly that make the channel possible. On that note, a special thanks to Bert Lamont for your generous support of the channel, my YouTube members, ex-subscribers, and all the patrons listed in the credits. I appreciate all your support, and thanks for tuning in.